So what are we going to cover today?
Mate, we're going to cover two things. We're going to cover, I guess, the four different reasons why you buy property, and also how being involved in property, a lot of people will actually transition through multiple stages of their journey from an investor through to a developer. And so the different stages that actually takes, and what are the signal points within yourself and within your portfolio that can tend to trigger that for many people.
Hi, everyone. Today we've got the champion Rob Flux with us. He's a property developer, educator, and mentor, and also the founder of Property Development Network, which is the largest property networking group in Australia. Rob, I'll hand it over to you to add more to that, please. And
thanks, Mina.
give us more insight to what you
mate.
do.
Mate, I'm coming to your audience today wearing two hats. I've got 35 years of experience in the property world. I did 20 years of buy and hold before going into the property development space. And we're going to talk a little bit today about, the differences between those and how and when to transition between. The Property Developer Network, for anyone who wants to know about my little baby, we're coming up to our 10th birthday at the moment, mate. We've been running that, as you said, it's the largest property networking group in the country. We run that in 3 states at the moment: Brisbane, Sydney, and Melbourne. And if anyone's keen to come to an event and learn about property development, they can come to our website, developernetwork.com.au, and go to the events page.
Perfect. Happy 10th birthday, by the way.
Thank you, mate. It actually starts this weekend for me, my friend. So I can imagine that there's going to be a hell of a hangover come Sunday, but I'm going to try and keep it in moderation.
Fantastic. So what are we going to cover today?
Mate, we're going to cover two things. We're going to cover, the 4 different reasons why you buy property, and also how being involved in property, a lot of people will actually transition through multiple stages of their journey from an investor through to a developer. And so the different stages that actually takes, and what are the signal points within yourself and within your portfolio that can tend to trigger that for many people.
Fantastic. Okay. So first we're going to start off with the passive investor. Is that correct?
Well, let's firstly start to talk about the 4 reasons to buy a property, because I think that sets the scene for everything.
It does.
Okay?
It does.
So there's really fundamentally only 4 reasons. So now we all tend to think that they're something bigger, but when you break it down to its core essence, there are 2 reasons as an investor, 1 reason as a developer, and 1 reason as just a mere mortal. So we want to buy for capital gain, capital growth. Okay, and that's an investor mindset, and the way you assess your property for that capital gain is going to be very different to a different kind of investor who wants to invest for cash flow. So different kind of product, different kind of location. So you're assessing things very differently. Then the next one is someone who does manufactured profit. So you want to force value onto the property in some way, shape, or form through the property development process. And the last one is lifestyle. We need somewhere to live and that sort of thing. And whenever somebody is buying a property, they should always be very clear on which of those 4 goals they're going for. And based on that, that's going to set the criteria on how do you assess whether or not this is a good property. Everyone is looking for, hey, where is the next hotspot? But there's a different hotspot for each of those categories. And even within each of those categories, there's different hotspots for, a townhouse versus a house versus an apartment. So when we get very, very clear on what it is we're trying to achieve, then we can actually start to assess our portfolio much, much differently. So be clear going in, and then make sure that on a regular basis, you're checking in with yourself to go, is my portfolio measuring up to how I assessed it was meant to go in the first place? If I invested for capital growth, is it getting the capital growth that I thought it would get? Because there's opportunities to say, do I pull the pin on that and put that money into a different property that's going to perform somewhere better?
Perfect. Completely agree. Yes. And aside, in relation to structuring for tax purposes and commercial purposes, that's also very important.
Absolutely.
Yeah,
Very different if you're wanting to be an investor as to whether you want to be a developer, different structures. Absolutely.
correct. If you want to be a developer, it's more prudent to potentially look at having a company in place so you can have more people invest, for example, have shares and put in equity, at the same time capping the tax rate at potentially 25%.
Well, that's
Whereas,
one of many ways. It depends on, are you doing it as a joint venture? You're doing it for yourself? Are you intending to keep some of the stock? Are you intending to sell all the stock?
correct.
Every time you
Correct.
try to do this, every time we go into a project, the entity that we want to create needs to be assessed very differently based on, well, how do I need to fund it? Who's involved in it? How do I intend to exit it? Because there's, probably 20 different permutations on how you might set up a structure based on, I guess, those criteria. So, you touched on a company being one, but there's unit trusts. There's
Correct.
I guess a discretionary trust with the corporate trustee that might then have a separate development management agreement. There might be all sorts of different ways of actually setting it up. And while we don't want to confuse our friends out there listening to us, we do want to encourage them to go get some good advice based on their personal circumstances and the specific deal.
100%. And even with those various entities, it can be a combination of them together to achieve the best outcome, both commercially and for tax purposes.
Absolutely. Now, I have a little bit of a rule of thumb because a lot of people don't understand the differences between a company and a trust. And without needing to understand how they work, it's more, what is their primary purpose? And a company is really great for trading and transacting. So if it's actually going to be turning things over, but more importantly, it's great at when it distributes its profits. Whereas a trust is really good for long-term holding, long-term capital growth, and it's really good for where it distributes its profits. So when you combine those two together, the when and the where, you might want to drip feed your payments over many, many years because you don't want to have a huge tax bill in one year and no tax bill in the next. So, those hybrid structures, cascading them together, that can be very beneficial.
Well stated. Perfect. Perfect. So take us on the property development journey.
Well, I guess most people start out there very similar to what I did, and they will start with the long-term buy and hold investment type approach, and typically they'll go in that with a capital gain type of approach. They want to build their net wealth. Okay, so capital gain builds wealth. What it doesn't build is money in your pocket. You become asset rich, but you typically cash flow poor, especially because a lot of the times you're doing negative gearing. And so when you're going in with that wealth creation strategy, at some point in your career, you want to be transitioning that into a cash flow generating scenario. So you want to think about that right at the very start to go, look, I might want to build it, but then roll it over. Now, that kind of investment is what I say is a passive investment. So you put a small amount of effort in up front to actually determine, are you in that right area, that somewhere with a lot of growth and a lot of capital, I guess, potential. And then once you put it in, once you buy that particular property, then you kind of let the market do the heavy lifting for you. And you sit back and you wait, and time will actually do the effort for you. Now, the rhetoric is that every 7 to 10 years, a property will double in value, but that's really based on, well, did you pick the right area in the first place? Did you assess for the criteria of the property? Because in many instances, we buy for the wrong reason. We might buy our house, for example, for a lifestyle purpose, and then we outgrow the house and we go, oh, we'll just turn that into an investment property because we already own it. And yet the intention was never for capital growth, and chances are it's in an area that doesn't have good capital growth. So when you start to look at your portfolio and say, is it working for me? In many instances, it's not, because we didn't have that clear purpose in mind when we bought it. I think the purpose changed.
Yeah, it's very important that you actually mentioned that, because some people believe that if I was to sell my house right now and buy a new one, the changes in the marketplace and in the sales value of the property doesn't make a difference. But it's important to recognize that not all areas perform the same.
No, absolutely. So there'll be absolutely some transactional costs. You get agents commission to sell it, and you've got some legal fees, and then you can have stamp duty buying the new one and a couple of legal fees buying the next one. So there'll be a small transactional cost, but that can be very quickly outweighed by, well, am I getting better capital growth by going into the other area? And you might go backwards a tiny bit, and then within a year or two, you've probably overtaken that loss and accelerating well past it.
Do you mind touching up just very briefly on what some things someone will need to keep in mind and look out for capital growth?
You want to make sure that you're in an area of high demand. That's making sure that there's a lot of population growth actually coming into the area, that a lot of services in the area, lots of jobs in the area. All of those things you can do all your research on the Australian Bureau of Statistics, your state governments, strategic plans. You get a look at the medium house growth in the area. And then there's also a thing called supply and demand. So is the amount of stock that is there outstripped by the demand? Now, a perfect example would be a bad example of that, right? So you don't want to go into brand spanking new suburbs where there's thousands of houses coming up because the developers rolling millions of these things out. You want to go into somewhere that's more inner city and the land is already consumed, and they want to live somewhere close to work, but there's not much of that stuff left anymore. So the less of it that's available, the less supply, and the more population that's in the area, the higher the demand. That's going to give you much higher capital growth.
Yeah.
Whereas I guess the next category, which is cash flow, it's probably the opposite. It's probably you want to be out in the burbs where those new land releases are, because it's cheaper to buy those houses right now, and people still need somewhere to rent, and they will rent out there. And so you can buy cheap now, and over time, the rental things on those things are going to make them very positively geared in a lot of instances. So where you choose is very different based on the strategy.
Yep. But it's always good to get into property as soon as you possibly can.
Well,
would you say that? Yeah.
I mean, I got into my first house at the age of 18. I got my first investment property at 21. So I'm gonna say yes, get in as soon as you can.
Yeah.
But I would candor that with saying it's never too late.
Yes.
And we've got some massive success stories with people in their 60s and 70s coming into the property development process and absolutely creaming it.
Fantastic.
So it's never too late, folks. You can teach old dogs new tricks.
Fantastic. And it's important, again, to have someone who's a good guide, a mentor, and educator to help you out, like Rob.
Thank you, mate. I appreciate the kind words.
Anytime. Pleasure. So can you take us from being a passive investor to someone who's more active?
Well, an active developer is someone, an active investor is someone who's actually putting their knowledge, their sweat equity into the process to force value onto the property. Now, in doing that, you have to do a lot of research to say, well, is there an undersupply of what I'm going to create? And can I flip it over in a very short period of time? So we're trying to manufacture profit against the market. So the market might be going up, down, or sideways. It doesn't really matter. We're trying to force value in there irrespective. So we're not reliant on the market. Instead, we are market makers. We are looking at, hey, there's a lack of supply of this particular product. Can I actually put that product in front of people because I can see the demand is there? Now, if we go back in time, Australia, 220 odd years ago, we were a one lot land subdivision. Okay. And everything that you live in, every shop that you go to, every house that you go to, every school, every road that you go on has been created by a developer who had the foresight to say, what is the demand in that area? And can I put a product in front of someone just in time for them to recognize that they need it?
Right. Could you elaborate on that?
Well, so
how do you mean? Yes.
So how do I mean? So we've got massive population growth. So let's just take that as granted, okay?
Yep.
So that population has to live somewhere. They don't have a choice.
Yes.
But the state government has to supply hospitals, they have to supply schools, they have to provide roads and train networks and all sorts of things like that. The health systems, local governments have to provide libraries and sewer and water and all those sorts of things. So the cost to create, I guess, the environment for people to live in is super expensive. And so those governments actually work, I guess, in a cohesive way to design, I guess, where we are going to be laid out. So we want to force people into certain areas because it's much more cost effective to build all of the infrastructure in one spot than spreading it out everywhere. So when you understand where the state government and the local government are pushing people to go, you're going to start to see, hey, the populations in one area are going to go up massively, and in other areas, they're not. So now you know where it's going to happen. Now it's about, well, if I know where it's going to happen, let's look at the demographic of the people. Are they, I guess, older generation where they want to have low maintenance and age in place? Or are they people with young families who need to have, I guess, a backyard for the kids to run around in? And so when we start to look at the demographic, we go, well, what is the product we need to create for these people? I know the people are coming. I know how many of them are coming, and I know what the supply is in the area for what they need. So if the supply is not enough, then we create a little bit more, and people will then come and buy it.
Fantastic points, and I see that I'm based out of the southeast of Victoria, and I can see that design and that planning, because now the estates are springing up where they have wetlands, they have residential property, and then they have commercial property close by. So people don't have to travel as far, generally speaking, depending on where their jobs are. And they can fairly easily access those various building services, so on and so forth.
Yeah, so I guess the cities of the future have already been designed. That's the key,
Yes,
Mina.
yes.
And it's about putting the effort in. And when I say an active developer, the effort is you need to learn where to go looking for those things. You need to go to the effort of actually reading those things. And then when you start to then measure, like, you know what's going to happen, now you start to measure, has it started to happen? When we start to see, has it started to happen, then we can go, well, is there enough demand that if I put something in place, by the time I'm finished, would that demand still be there? And so it's all about the data telling us a story. And if we can read the data, if we can understand the data, it's like the Matrix. You see the little ones and zeros come racing down, but what it's doing is painting a picture for us to go, well, it makes sense to put our money over here because I can see that the demand is there.
100%, 100%. So being someone who's an active investor, active in property development, means that you are putting the sweat equity in. I'm just summarizing, right? You actually understand where to obtain the information and understand how to utilize that information.
Yeah, and it's like learning a new trade, okay? Yeah. So, people go to university for years to learn to become a doctor or a nurse or whatever it is, right? So property development is no different. You need to actually start to learn the trade. And a lot of people jump in with the idea of get rich quick, and it's not. If you do that, it's quite dangerous. If you instead spend the time to educate yourself and actually know what you're doing. Warren Buffett has a famous quote where he says, risk only comes from not knowing what you're doing. So when you start to actually teach yourself what to do, then the risk starts to disappear, right? Now, it never goes away. What we do is we put a risk management plan in place. And so we can see the risk and we can manage around the risk. And in doing so, we solve people's problems. And when we solve people's problems, people pay us for the privilege of doing it, because Joe Public doesn't have the knowledge, the skills, or the patience to solve those problems for themselves.
Correct. And the learning curve with these things can be absolutely huge. And it's about, finding the right property, the right area, the right tradies to work with, understanding the infrastructure that's required to actually build these things. What else is required, just as a big picture?
Well, I think as a big picture, it can be daunting looking at all of that, Mina. And so we try to, in our
Yes.
network, we have a program called Property Development Formula, and we teach people how to narrow down the focus, right? And if you can narrow down the focus and say, look, I only want to concentrate on getting really good at one thing. And if I'm really good at one thing, then I'm going to know exactly where to do it. I'm going to know exactly how to do it. And I'm going to get very, very efficient and very effective at doing that. Because making money can be boring, mate. It doesn't have to be all risk and excitement. We want to get it so that we can do these things as cookie cutters and just keep rolling them out. So it's going to take you a little while to learn the first one, but then we just start to scale the process. So, you know, build 2 of something, then build 4 of something, then build 6 of something.
Yes.
And eventually we just get to a point where, hey, we can actually start to keep one as profit. And when we keep one as profit, then we've got this little loophole that in tax law that basically says you only pay tax when you actually realize your profit. So if you don't sell the last one, then you've effectively got a tax deferral scheme that says, well, if I sell that in 20 or 30 years' time, I'm keeping 100% of my profit in the deal at this point in time. So, which means that doubling every 7 to 10 years, well, now we've got 100% of our profits doubling every 7 to 10 years, and we've managed to keep one as stock, which means that we've manufactured positive cash flow. So we've manufactured the profit, we've created a product out of thin air, we've created an asset that's going to grow with capital growth, and because we own it 100% outright, it's going to give us cash flow. So magically, the manufactured profit thing can actually get you 3 out of those 4 scenarios.
Fantastic. Fantastic. And overall, property is a long-term game. Correct. So we need to be patient with the process and understand that it's a worthwhile asset to actually learn.
Absolutely. So there's definitely learnings in taking your time to actually learn it. That's where our networking groups, Property Developer Network, that if you want to come to one of our events, learn, see real evidence of people doing real deals every single month in every single location. And we've been doing that for 10 years, showing people that it can be done and how it's done. Know that it's possible. Know that it's very easy to do when you learn, when you take the time to put the effort in. But we've touched on, I guess, passive investors. We've talked on active, but there's this phase in the middle where people go, well, I think I want to transition. I'm not quite sure. And that's what I call semi-passive, right? So what we tend to find is people try to do the investment approach, and one of 2 things tends to happen. They tend to find that the capital growth is a little bit slower than they would have liked, and they're not going to make it out in the timeline that they wanted, right? So they say, what can I do to actually start to accelerate this? And so they look at the property development world and they go, maybe it's a little too scary yet because I haven't done that education. So how do I eke into the process and learn as we go with it and minimizing our risk? Okay. Now that tends to happen where 2 things occur. Either the person has, picked a property 10 years ago that's got some capital growth. All of a sudden, the city has expanded. The demand has come into the area where they have purchased. Now that site has suddenly become quite an attractive development site, and the person doesn't know what to do, right? So they go, well, I know it's developable. I know it's going to be profitable. I just don't know how to do that. So that's scenario number 1. And in that instance, you would come to a network like ours and you'd find that, one of our 16,000 people out there actually do know what they're doing, and they can partner with you. And so you can shadow them, you can learn from the process. And I guess 2 of you get to benefit from that process, and both of you get to profit, and you get to shadow and learn as you go. So that's one way. The other way is that they've invested in a property and it's had massive capital growth, but it doesn't have the development potential. But you've actually generated that wealth that we were talking about before. And you go, well, how do I actually turn that wealth from an asset into a cash flow scenario? And there are ways of working with developers to say, well, we need equity. We need the access to, that sort of capital. And so if we can work with you, we'll quite often pay you a cash flow out of that. Sometimes it'll be anywhere from 10 to 25% interest based on the amount of equity that you can actually tap in. And again, you get to shadow a developer in the process. So you're kind of co-developing with people and learning as you go in that process. So that's kind of the middle ground.
Fantastic. And just on that very quickly, from a tax aspect, where something is going from a passively held asset to something that's active, there's potentially a change of use asset that happens there. And the stock value, instead of it being valued at the purchase price when you first bought it, it actually gets changed to the market price. But reach out, speak to an accountant, a tax advisor, to help you and guide you through that to make sure you're eligible.
There's also a couple of opportunities there where you might be able to apply for a private ruling with the ATO to say, look, all you're really doing is realizing the capital that has occurred, because as the city's grown to you, they've rezoned the area. And so farmers are a perfect example where, originally it was rural land and now it's actually become suburban land. In many instances, they can apply for the private ruling to say, yes, what you're selling was your PPR and has been for many, many years. But what you're really doing is just realizing the capital that has inherently been forced upon you by the market.
Yes. Fantastic.
By the way,
fantastic.
Go talk to Mina. He'll help you. He'll guide you through it.
Thank you. Thank you. Always happy to work with people who are looking to explore, how to grow and how to invest, and working with people like yourself, Robert, who are effectively educating and helping those people along their journey. So, Rob, I want to ask you, how does one reach out to you? Where are you available?
So we have a number of different ways to reach us. There's a Facebook community. So if you jump on Facebook and search for Property Developer Network, you will easily find us. We run a networking group. Again, just Google Property Developer Network, and that will come up with our Developer Network website, and go to the events page. We have a YouTube channel where I do similar to these sorts of podcasts, mate. Every single week we're releasing content for people to actually learn. So go to YouTube and search for Property Developer Network.
Amazing.
And engage in our Facebook community. Our Facebook community is a great place to actually ask questions and say, hey, I don't quite know what to do in this particular scenario, and the community will actually help you. It's for the tribe, by the tribe, with everybody helping each other move forward.
And how do we find that Facebook community? Is it through the Facebook page?
Yeah, so go to Facebook and just type in Property Developer Network and you will find us.
You'll find the group? Okay.
Absolutely. Yep.
Fantastic. All right. Well, thank you very, very much for your time. We sincerely appreciate it. And we look forward to doing something else with you in the near future.
No worries, Mina. Thank you for the invite, mate. And chat to your audience.
Thank you very much. See you, Rob.
See ya.